It's that time of the year, that's right, it is tax time. And I know nobody really likes to talk about tax time, but if you are planning on buying a home or refinancing a home, you want to make sure to tune in to get the scoop, because your tax return can impact your ability to obtain a home loan. Here's what you need to know. All right, let's chunk this down into two separate categories. The first category is going to be if you are a wage earner receiving a W-2 and you do not own more than 25% of the company that's giving you the W-2, or you're a W-2 wage earner, but you have a side hustle. Maybe that's a side business where you are filing a Schedule C or a business tax return for your side business. The side business is important here. And when I dive into the self-employment lending guidelines with regard to how income is derived, that side business, even if you are a straight W-2 wage earner, could impact your ability to qualify depending on what you show in that side business tax returns or Schedule C on your personal tax return. I know, it's like a bunch of blah, 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 right? Straight W-2, boom, easy peasy. Now, if you are already pre-approved, and let's say that something has changed in your cadence of how many hours you're working per week, not that it's going to impact your tax return, but you definitely want to make sure that you are talking with your lender that pre-approved you, because once there's a variation in your hours worked, depending on the loan program, that could impact your usable income, and that could change your pre-approval status. So make sure that you're communicating back to your lender if your hours worked vary. All right, let's dive into this whole tax return thing. If you're self-employed, or even if you have a W-2 and you have a side hustle, so you have a side business, what you file on your tax return for mainstream financing, that's going to be FHA, VA, USDA, conventional conforming, Fannie Mae, Freddie Mac, and most jumbo loan financing is going to be driven by what you show on your tax return. Now, everybody from a self-employment standpoint, the goal is to reduce your tax liability. But from a home lending standpoint, home lending guidelines do not look at your gross income. And we often see that once that tax return is filed, that net income, especially on a Schedule C, let's talk about that one because that's the easiest one to think about, especially if you have a side hustle that's a sole proprietor. Schedule C gets filed on your personal tax return. If you just kind of look at that, you're going to see like gross receipts towards the top, and then you're going to have this middle section of the Schedule C where it allows you to depreciate, write things off, etc. Line 31 of that Schedule C, take your eyes right there. Look at line 31. If that is a negative or that number is drastically lower than what your gross receipts are, that could be problematic for you when qualifying for a home loan if that's your only source of income. Because from a lending standpoint, especially on that Schedule C, while there's a few things in there that lenders can add back in, the lending guidelines are really focused on that line 31. And very often we will see somebody who maybe made $300,000 in gross receipts, they've written off $280,000, so line 31 could be $20,000. So if there's nothing else the lender can add back in there, and again, this is not at lender discretion, these are mainstream lending guidelines, there's nothing else that can be added back in on that Schedule C, then you would take $20,000, divide it by 12, and that's going to give you your monthly usable income that the lender is going to be using to qualify you for your home loan. Now, let's say you already went through the pre-approval process and you're like, hey, Kelly, I'm good. The lender already reviewed my tax returns. I've got a pre-approval. I've been shopping. Here's what you got to know. Once you file that 2023 tax return, now that tax return is going to take precedence. And if the lender used 1 year or 2 year tax returns, again, lending guidelines will vary depending on what is required. But let's say that the lender was using 2021 and 2022 tax returns. Well, now 21's out the door. Once you file your 2023 tax return, 22 or potentially even 23 is going to be what is used to qualify you for your home loan. And I'm sharing this with you because if there's something material that's changing between your 2022 tax return and your draft on 2023, before you file it, stop and talk to your lender. Let them review it, because I have seen it time and time again. You already have a pre-approval, you're out there shopping, not thinking about it, you file your 2023 tax return, and guess what? if that income has changed dramatically, maybe there was a big loss, something's going on that you weren't even thinking about, that your CPA is doing their job, reducing that tax liability, that could absolutely impact your ability to qualify for a home loan. I know it. I know you don't like it. We don't like it, but it is the way that it works in home lending, especially this time of the year. Another scenario, let's say you have been pre-approved already with a lender and the income that was used was W-2 income, and maybe you decided to turn that side hustle into a full-time gig a couple of months ago and the lender isn't aware of it. That too can impact your ability to qualify, because now that W-2 job is gone and 100% of that income, unless you have some other usable income source for the home loan, now that income is going to be derived based on your self-employment income only. And from a lending standpoint, the lender's going to want to see a full year's tax return, meaning the full 12 months. Sometimes, depending on what's going on there, maybe we can make a case for it that the business has been in business for a year or two. Maybe, depending on what's going on, maybe it's 11 months, not 12 on that tax return. But if you just started the business in, let's say, October of last year, and now you're trying to use that income to qualify for a home loan this year, and that's your only income source, that's going to be problematic, because technically you've only had 3 months of self-employed income on a tax return. Just moving forward, pay attention to that tax return. If you have questions, use a lender that is highly skilled in self-employed borrowers and home loans, because it is not an exact science. While lending guidelines set forth certain criteria, there are nuances between all of these loan programs on what is required, how the loan program guideline requires the lenders to get nitty-gritty into the details, what can be added back in, all kinds of things. So make sure you're using a lender that understands the nuances for self-employed borrowers, because it can make or break your ability to buy or refinance a home. Now, that tax return, again, that's going to be for certain home loan programs, but there are loan programs out there that don't require the tax return to be used to derive income. If you know your tax advisor and you are doing everything you can to minimize your tax obligation, then using a home loan program that's using the tax return to derive income may not be a good solution for you. But the good news is there are other loan program strategies out there that would allow you to qualify, maybe based on bank statements, etc. So that whole bank statement program is really trending right now because self-employed borrowers want options, and that would give you a different way to approach home lending without having to use your tax return to qualify. Now, is there a catch? Yeah, there's a catch. Generally, it's more money down and the interest rate or terms are not what they would be if you were taking out mainstream financing. But even if the interest rate's higher, does it really matter? Because if you were to try to use that tax return to qualify, you're probably increasing your tax liability. So it all kind of works out in the wash. But don't be afraid of that sticker shock when that lender says, oh yeah, we have a bank statement program and here's how it looks. Like initially you're gonna be like, what? Process it, think about it, and you can ask your tax advisor, hey, if I was to show X dollars on my tax return, how much would my tax liability be? That right there might settle you down and have you okay paying that interest rate on that bank statement program. So I digress. I'm sharing this with you because after being a loan officer for 28 years, there have been so many different scenarios with our clients where they just don't understand the impact that filing that tax return has on their pre-approval or their ability to buy or refinance a home. Lenders who specialize in self-employment income and strategy is key because it's just not black and white. So if you are self-employed, again, find a lender that you feel like you can trust, that can give you the insight and walk you through your options. Now, we can lend in 45 states plus Washington, D.C. And if you have any questions, click the link below and schedule a quick consultation with the Kelly Zitlow Mortgage Group advisor. We're happy to kind of walk through where you're at, where you're going, what's going on those tax returns, how long you've been self-employed, etc., and give you some direction and advice that can get you to the finish line of home ownership and a home loan. Now, here's the disclaimer. We are not tax professionals. We are mortgage professionals who are going to look through your tax return and calculate the income based on the lending guidelines. So for true tax advice, please be sure to consult a tax advisor. That's not us. Now, we've only scratched the surface when it comes to self-employed borrowers. If you are looking for more information about self-employed home loans, stay tuned for my next video on how self-employed borrowers get a mortgage in 2024. Thank you so much for watching. Please subscribe to this channel.